Hello, today on the final bar, we'll be talking to Sean McLaughlin from StockCharts. Get a particular options idea from him. In a choppy day in the markets, the S&P sort of ups and downs through the course of the day, opening lower, trading almost to zero, to the zero level midday after lunch, but then coming off, going into the close. So overall, a bit of a further weakness. The real story, though, strength in bonds, weakness in commodities, weakness in crypto. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is meant to help us better understand investor psychology, better appreciate market dynamics, and learn the lessons of market history. I was taught the markets never repeat themselves, they often rhyme, and that is absolutely what we're seeing now. A lot of similar characteristics to previous bear market cycles. We're actually in the process of creating a mini documentary focusing on this current market, how it relates to some of the previous bear markets over the last 35 years. But overall, you're seeing these bear market rallies that emerge and then fizzle a bit. And today, I think sort of following through on the rollover that we saw after the rally, last week into this week, a choppy phase overall. You're seeing leadership and laggardship that rotates a bit. Today, a defensive feel to a point with utilities and consumer staples, two of the top three sectors, energy, communications, services, technology, consumer discretionary, all down over 1% today. That's weighing pretty heavily on the market overall, pushing things a bit to the downside. We have great guests on the show. I'm excited to talk to Sean McLaughlin here in a few moments. Coming up next week, as a reminder, Monday, we have the market holiday for 4th of July. So wish you all a great 4th. Hope you're able to celebrate safely with those around you. On July 6th, we have Jesse Felder, editor of the Felder Report. Coming up the week after, on the 13th, we have Sam Burns from Mill Street Research in Boston. And then on the 14th, the Fibonacci Queen, Carolyn Barodin, joining us on the show once again. Let's continue on today's show with our market recap. As I mentioned, a choppy feel to things overall. Let's break down some of the details and see what we can learn about how the market environment has evolved here in the last 24 hours. The S&P finishing down just under 1% to 3786, pretty choppy in the last hour, but settling in there. And that's after a run higher into the early afternoon. The NASDAQ composite down about 1 1/3%, mid caps, small caps all down as well. The VIX bouncing up a little bit, just below 29 at the close today. Bonds really moving higher here in the last couple of sessions. The TLT up about 1%, a little less than that, and interest rates continuing to pull off. So the 10-year yield actually back below 3% by the end of the day today, around 297. Now it's interesting because overall we've talked about this higher interest rate environment. My conversation yesterday with Samantha LeDuc is about the prospect of rising inflation, higher interest rates, and how those themes could continue to play out. In the short term, though, if people treat bonds as sort of a safe haven and rotate to the relative safety of the fixed income markets, that can bring yields down, certainly in the short term, at the very least. And that's sort of what we're seeing here so far this week. Commodities, a lot of red here with the GLD, one of the better performers, only down 0.6%, silver down almost 3%, oil prices down as well, natural gas down fairly aggressively. As a result, the energy sector, the worst performing of the 11 S&P sectors. We'll look at the rest of the sector movements here in a few moments, but I did want to highlight cryptocurrencies where there's a ton of red. We've talked about, again, days like this where you have a severe move to the downside, that may surprise you in terms of the severity and the quickness of the move to the downside. What I hope does not surprise you is the direction of the trend, because it's been very clearly to the downside, I would argue, in pretty much all of these 10 most liquid coins that we're tracking here. Bitcoin down about 6% from yesterday. Ether down about 7.5%. And Ether is right at that key 1,000 level. So one of the charts that I shared just recently on social media today was looking at Bitcoin. And Bitcoin is one of those where big round numbers matter. Now, I talk about big round numbers on a lot of charts. That is a proven dynamic in the financial markets because so many people essentially place orders around big round numbers. So as a result, there's usually a lot of clusters of trades and usually a lot of support and resistance to be found around those big round numbers as a result. If you look at the chart of Bitcoin, and apologies for having about 8,000 lines on here, but the thick sort of blue horizontal lines indicate those big round numbers, 10,000, 20,000, 30,000, 40,000. Look at what has happened when it's approached any one of those key big round numbers. You've had a consolidation. So we sold off to 40,000 at the beginning of the year. We spent about 3 months sort of chopping around that level. Eventually in April, finally broke down to 30,000. We spent about a month there. We then came down to 20,000. Now have chopped around there for the last couple of weeks. Today, we're rolling over yet again. My concern is that next downside target could be 10,000, which would follow that pattern. I would be looking for opportunities along the way, and particularly the momentum, right? It's severely oversold on that last move lower, and you want to look for a new low that does not become oversold, sort of a bullish momentum divergence. We're not seeing that yet. You're seeing more downside momentum than anything. The reason why I'm bringing that up is Ether is right at the 1,000 level, and I would argue that is a pretty important level that I think a lot of people will be focusing on. That was the low close for the year so far. That led to the bounce over the last couple of weeks. As we retest those levels, you always expect some sort of support. The concern is if that support does not hold, what's the next level down? And that's when a down move can sort of accelerate. Just briefly on sectors, a defensive field to a degree today with utilities number one, consumer staples number three, industrials second from the top, up 0.3%. So utilities really the best performer here. And the relative strength of utilities is an important one because what I have found is while there are some limited times when a bull market happens and utilities are kind of leading to the upside, utilities tend to perform better on a relative basis in a down market because it's more of a stable, income-oriented, low volatility sector. So the fact that that's leading today does not give me a warm and fuzzy feeling about the opportunities going forward. Energy pulling back, and we talked, I think, yesterday about the chart of FANG, Diamondback Energy. We've talked about DVN, Oxy, some of these other names that have had really good runs and have pulled back quite a bit. So still doing very, very well year to date, but showing some short-term weakness. A lot of those are testing key support levels, and I would be looking to see if they're able to hold. You know, when we talk about this market and we talk about the story of 2022, part of it is, rising rates, rising inflation. Part of it is the strength in commodities and the energy sector and how much of an outlier it's been. But a really important one is the weakness in growth areas of the market. And I think I'm going with the Manamana stocks, but I'm still working on that acronym. But basically an adaptation of the FANG stocks, because you have to incorporate Microsoft. I'm thinking if we put NVIDIA and Adobe, that would be literally Manamana, and we might go with that. But all 8 of those stocks are in a downtrend, right? So a bull market phase can begin or a bear market phase can stop when some of those stocks, if not all of them, are starting to put in higher lows. All of them kind of rotating and continuing to make new lows at or near new lows here, and certainly making lower highs. So when you look at the chart of Microsoft, lower lows in June and retesting the 50-day and rolling over. Netflix, obviously very much in a downtrend, has not broken down, but is again heading back toward those lows from mid-May and early June. And I added a couple other ones: Adobe, NVIDIA, all 8 of those, either at or near new lows and certainly making lower highs. So that trend has to evolve, right? For the indexes, for the major benchmarks to do better, the biggest names that are really driving the values of those benchmarks have to improve. The markets can go down, the indexes can go down with energy and materials raging to the upside because they're just not enough of a weight to cause the indexes to change their pace. These growth sectors are the ones that you really want to probably be paying attention to. Just to finish off, I wanted to look briefly at a couple breadth charts. We had a segment yesterday on market breadth, and today we're going to do a segment called Getting Sentimental. We're digging into some of the sentiment data. But the one chart, yesterday that we were talking about are the advanced decline lines. All 4 of them, rolling back down today. As you're seeing further weakness in stocks. But, it strikes me all 4 of these, the NYSE advanced decline line, large caps, mid caps, small caps, all 3 of those making a new low in June. So when you're thinking about the short term, the tactical movement versus the long term, this is the chart that comes to mind, or one of them that comes to mind when I'm thinking of the long term rotations, when I'm thinking about the trends and the fact that even though we have these bear market rallies, these quick, sudden reversals to the upside, the overall pattern in all of these advanced decline lines is a downtrend of lower lows and lower highs. Get excited when that pattern changes. Get excited when that is no longer the case and where you start to see an improvement there. You know, another one, we didn't actually get to this one in our breadth discussion yesterday, so I wanted to highlight it here before the break, is new highs and new lows. You see very little green on this chart, and the reason is because we haven't had a lot of new highs recently. And really, if you look at the last couple months, the last time we had any stocks making new 52-week highs was back when some of the energy names were doing that in mid-April. From there, it's been minimal, right? I mean, just a handful of names at times. There's a lot of red on there, and you're starting to see some increase in the red histogram, which shows you that a lot of names, more and more names now every day, are starting to make new 52-week lows. A bear market phase usually sees an expansion in new lows and an evaporation in new highs. That's what I'll be watching this chart for, to see if that continues on. That's our market recap today. Very quickly before the break, just wanted to let you know we heard bad news today. One of our StockCharts contributors who gave us some great expertise recently in your Daily Five, Andrew Cardwell, passed away this week, which was really sorry to hear our contributor, Bruce Frazier, let us know about that earlier today. Andrew Cardwell was a pioneer in the use of RSI. So if you use RSI, if you use momentum indicators, if you've thought about overbought and oversold conditions and how to think of them, and use RSI in any more sophisticated way, you are most likely using some of the groundbreaking analysis and expertise that Andrew Cardwell shared with us. I had a chance to meet Andrew a number of times at conferences and very much appreciated his commitment to educating others to use a key part of the technical toolkit. So rest in peace, Andrew Cardwell. We'll be back in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the data visualization techniques and technical analysis toolkit to better understand the financial markets. A couple quick announcements before we get to today's guest, Sean McLaughlin. First off, we welcome your feedback and we very much appreciate your questions. We are here to help point you in the right direction as you are trying to use stock charts using technical analysis to understand your portfolio, to make buy and sell decisions, to manage risk, preserve capital, whatever it is you're trying to do. Let us help you. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air tomorrow on Friday's show. Also go to stockchartstv.com. That is our on-demand platform. Great guest experts like Sean McLaughlin, Samantha LeDuc, Larry Williams, Martin Pring, John Murphy. So many great perspectives every trading day for free at stockchartstv.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at All Star Charts, coming to us from Colorado. Sean, good to see you. Welcome back.
Hey, Dave. How you doing, buddy?
Hanging in there, my friend.
Hey, I know you're a big LL Cool J fan, and when you were talking about Phenomena earlier, I was thinking, man, we should have our people called LL Cool J's people. Maybe he could take his hit song Phenomenon and rework it as a theme song for your little thing there.
I like your thinking, Sean. We'll pursue that for sure. Getting back to the charts, if we could, looking at your first chart of the energy sector, right? So energy has been such an outlier this year, right? It's sort of been energy and everything else. Pull back a bit, break down the chart for us. What are you seeing in this space?
So as you mentioned, energy's had a tough couple of days here, and it's had a tough couple of weeks. It's been this, and the commodity space in general and fertilizer stocks, things like that, have been the outlier all year, the only sectors that have seen green for most of the year. And as such, it attracted a lot of hot money. And so we're looking at this chart now, we're looking at the recent price action, and we're thinking, this one of two things is happening here, perhaps both. Hot money is kind of starting to evacuate the space a little bit, and now maybe normal supply and demand dynamics are going to take over. Or this is the start of something bigger. Maybe that was the top in energy that we saw 3 weeks ago. Dave, I don't have the answer. I can't see the future, But the trade we put on as options traders is we think the market's going to it's going to take a little time to figure this out. So we're betting on some sloppy action.
Yes, you've sort of given this range 65, 85 sort of thing, and you have an options play for us. Can you talk us through what you would be doing here and why?
Sure. So the options trade that we put on is we're making the bet that XLE is going to stay within that range between 65 and 85. We stuck with the 65 level on the downside because there is some price memory at that level. That was a level that had acted as support in the past, also as resistance if you go even further back. So that level has some price memory. As far as the 85 level on the upside, that just felt comfortably far away for us, and there was a lot of premium in those options. We're looking at the August expiration options, by the way. And so a trade like this, Dave, is a type of trade that we're betting on sideways action. We're betting on the implied volatility that's driving the price of these options. We're betting on that volatility to come down. And right now, of all the ETFs that I track the 30 or 35 ETFs with the largest options volume, the most significant options volume. And right now, XLE has the highest implied volatility of all of the ETFs that I track. So for those reasons, we think this is a great candidate to sell premium in. We sold this spread for $2.75, again, selling the 65 puts and selling the 85 calls. And as long as we stay in this range, we should have no trouble making a profit on this trade.
And so for those that are not optionistas but are trying to understand this, the way I would translate your graphic is as long as the price remains between 65 and 85, you basically collect the premium there. And so you have you have a limited upside, but a guaranteed upside of that amount. If it gets outside of that range, that's where you could have potential losses. That's right?
You are absolutely correct. The most we can make in this trade is 275 if we held this all the way to expiration. That's rarely something we do. We'll usually take our profits when we've captured half of it. But from a risk management point of view, we like to keep it simple here. If we're making the bet that we're staying between 65 and 85, if we see XLE close above 85 or close below 65, that's our signal that we're either early or we're wrong. Either way, we're not going to argue with the market. We're going to close our position and book a likely loss, but potentially a small profit, depending on the timing, of course.
I love that idea of not arguing with the market. There's a lot of wisdom in that comment there, Sean. We only have about a minute left, but when you're thinking about this broader market, obviously energy has been the outlier, but overall, stocks have continued to make new lows pretty much every month this year. Are you guys seeing any conditions that tell you to start being optimistic overall, or is it still sort of defensive mode and wait for the charts to tell us differently?
We, as the analysts here at All Star Charts look at things, we are in the opinion that the market needs to prove itself to us. We're not willing to call the bottom here just yet. We're still seeing a lot of damage underneath the surface. We're still seeing new lows exceed new highs on many time frames. And so we're not sticking our neck out to get long here, Dave. We're not saying the market's going to crash from here, but it doesn't feel like the time is right to be making bets on a bounce from here.
I love the comments. There's again, a number of times you've mentioned letting the evidence sort of tell you what to do, which is a wise and very thoughtful approach there. Sean McLaughlin, listen, it's great to see you. Stay safe there in Colorado. Be well, and we'll talk to you again soon.
Thanks for having me, David.
That's Sean McLaughlin. Sean's the chief options strategist at All Star Charts. If you think about it, I love that comment. I mean, if you're not familiar with some of the options plays, a short strangle, he explained it very, very well in terms of what you're trying to do. It's such a great opportunity. If something is sort of chopping around, it's going that painful third direction, not necessarily higher, not necessarily lower, but just kind of sideways. For me, as pretty much a plain vanilla equity investor, your levers are limited, right? There's only so much you can do if the price isn't moving. As an options investor, you have this whole additional aspect to what you could do, which is profiting when things are not directionally moving up or down, they're moving sideways. So great illustration of where options could fit into a strategy, even if it's just a choppy sideways market that's expected. Great take there from Sean McLaughlin at All Star Charts. Let's continue on with our next segment, Getting Sentimental. We like to check in on some of the sentiment data on a Thursday. A lot of the weekly data is updated Wednesday into Thursday. So Thursday is a good time to sort of review what's come out and pay attention to things. And I have sort of three pieces that I like to dig into when we're looking at market sentiment. First off is volatility. So if you look at the VIX, This is basically illustrating the implied volatility based on the options market. So basically, what's the volatility implied for the S&P 500 is essentially how I would summarize what it's trying to tell you. The VIX is going higher. That's a more volatile environment, and usually, while it's often called the fear gauge, I like to think of it as more of an uncertainty gauge. It's not necessarily. I think fear is at all times. I think there's always fear in the market. This is more uncertainty. This is more of an instability gauge, right? Are we more uncertain and more anxious? And that's when this can go up, because volatility is usually driven by excessive trading and uncertainty. So we think of it in volatility regimes. You can see these horizontal lines that I've lined up in the last 6 or 7 months. I think shows us where we're at now. In mid-2021, we had a period of relatively low volatility where the VIX was ranging between 15 and 25. Now in 2022, we're about 20 on the lower end, although we've undercut that a little bit at times. And then on the upper end, sort of 30 to 35 is where we've peaked out in volatility. So what's interesting is if you look at the VIX in that range and you look at the trend in the S&P 500, you can see that the peaks and the valleys in the VIX over the last 6 months line up pretty well with the peaks and the valleys, obviously inverted with the S&P 500. So the market tends to peak at low volatility, it tends to bottom out in high volatility, which is why recently when the VIX gets above 30 and the S&P is selling off and making new lows for the year, it certainly seems like a good opportunity for a bounce. Here's the challenge. If things really get crazy, and what I mean is a movement accelerates to the downside, you get people really starting to get anxious about the markets, the VIX can go way above 30, right? It can go way above 35. It can even, as we saw in March of 2020, go up into the 80s. Now, why that might not be a realistic target for the next week or so, it does tell you that there's no, clearly defined upward bound on the VIX. So it's not like an RSI, which is more of an oscillator oscillating between two extremes. The VIX is, bound at 0, but on the upside, it can go up much, much higher. So betting purely on the VIX above 30 as a bottoming signal can be okay, but it's not necessarily a lasting bottom. And that's what I would be looking for. If we do start to sell off, look for the VIX to accelerate above there. If and when it would sort of find a peak and rotate lower, that's most likely a tradable bottom in the S&P. But for now, it's telling me elevated volatility, elevated uncertainty. When we look at the AAII survey, this is a weekly survey of individual investors. Basically, are you bullish, bearish, or neutral on stocks for the next 6 months, I believe is how they are asked. Last week, we had a continued decline in bulls and an increase in bears. This week, a bit of a reversal to that. We had a couple more bulls. We're at 23% bullish, 47% bears. So bears still outnumbering bulls by about a 2-to-1 ratio. And the spread between the two is about 24 points, or 24%. So last week, the spread between the two was one of the highest levels we'd seen in quite some time. It was over 40% difference between the two. This week down a little bit, but overall still very much in a different phase. Look at the market here, end of 2021 to sort of the first 2/3 of 2021 going into the fall, and look how bulls clearly outnumbered bears. This is a bull market environment. This is where the disbelief phase of the rally off of the March 2020 lows became the acceptance phase of where investors are sort of all in and assuming the trend is going to go higher. Then we had this sort of choppy rotational period, November, December, January. You can see that the spread between the two was more even. You can see that we sort of flipped up and down, but overall rotating around the 0 level. And in 2022, there's been 1 week where we had bulls outnumbering bears. That was on the rally in March. But other than that, it's been significantly higher numbers of bears. You see how the entire histogram here at the top has shifted more and more negative. So overall, this trend is basically suggesting there's a lot of negativity. There's no real optimism that you're seeing from individual investors. The markets often bottom out when there's an excess of bearish sentiment out there, but we haven't seen it. We've seen extreme bearish readings that have led to additional downside. So at this point, I'm not seeing anything to get too excited about. Finally, the name exposure index looks at active money managers and where they're allocated, currently 30% to equity. So this is literally a question of what's your allocation to the equity space. Last week, it was down to around 20%. So we're up a little bit to 30%. That's still very much below the long-term averages of around 70 to 80% on this indicator. So basically, money managers still very underweight the equity space, very much on risk off mode, very much defensive. Finally, the put call ratios, and this is a way of looking a different look at the options market than the VIX, but basically looking at positions on the put side and the call side. This total ratio includes equity and index options. The next one we'll look at is just equity put call ratio, so equity options only. And what I would tell you is if you compare where we're at now versus 2020 to 2021, at least the second half of 2020 and most 2021, we're at the upper end of the range. But if you look at where we're at right now versus where we've been at in 2022, it's almost the middle of the range that we've been in. The put call ratio has spiked up quite a bit on these sell-offs as investors have gotten fairly defensive here. We've pulled back a little bit, which tells me we could be setting up for a bit of a bounce higher in the put call ratio, which usually would line up with a bit of a downtrend in stocks. The equity put call ratio, same sort of thing. We're at the upper end of where we were in 2021. We're actually exceeding the levels we were in 2021, but 2022 has seen the entire ratio move higher. We're about mid-range to where we've been, and we're coming off some excessively high levels here earlier in June. So the put call ratios have come off a little bit. That lines up a bit with the rally that we've seen here in stocks, meaning a little less negativity. I wouldn't be surprised. Now we're at the lower end of the range that we've been for the last 6 to 8 weeks. If the put call ratios would bounce higher as we would get the next leg lower in stocks. That is our segment, Getting Sentimental, reviewing some of the key market sentiment indicators. Let's transition now to the end of the show, the 3 in 3. 3 charts in 3 minutes. And what I wanted to do is select a couple different looks. We've got an ETF, an individual stock or two, if I remember right. And let's get right to it. Chart number 1 is the utilities sector, XLU. In our market recap, I pointed out that utilities are the #1 sector today, not killing it, only up about 1% if I remember right, but definitely the strongest out of the 11 S&P sectors. Here's the problem with that. Utilities tend to do pretty well when investors want to get defensive, because I know as working with institutional investors, you'd rotate utilities if you wanted stability, if you wanted low volatility, and you wanted income, right? You wanted to take advantage of the dividend component of the utility space, and we're ready to just hold off and weather sort of uncertain times. So the fact that utilities are doing so well, very close to making a new 12-month relative high today, not quite doing it, but very, very close, shows me that investors are continuing to bet on utilities on a relative basis. On an absolute basis, it's not the most exciting chart ever. We've sort of rallied here very quickly. This is as rates have come down, and then as energy has come down as well, because when interest rates are super high, the income side of utilities are a little less attractive. Now the rates have come off a little bit as people are moving to the relative defense of the fixed income space. We're seeing the utility sector bounce higher. So as a market indicator, continued relative strength in utilities tells me 2 things. Number 1, it might be a good idea to allocate it to utilities. And number 2, it's not a great sign for the markets as a whole. Chart number 2, Caesars Entertainment, ticker CZR. We've talked about the gambling stocks a couple times in recent weeks. If I remember right, these are names that bounced up. And about a week ago, we saw this huge upswing where it was gambling stocks. Airlines might have been in there, sort of travel, tourism, hotels, cruise lines all had this really killer day when it was sort of this one day feel that everything was going to get better very, very quickly. We've now retraced and more from that one big update from last week. 2 things I would point out here. Number 1, if you take a step back and just look at this chart, it's in a clear downtrend. Well-confirmed levels of support are failing. And most recently on Caesars, it was 70 here in January, in February, tested it again in April, finally broke it, retested that level from below, and then rotated lower. That's not a great look, and attempts to make new swing highs have fizzled as it's rotated lower. Most recently, we got up to 45, well below the previous swing high, and now we're back to retesting the lows. It's close to making a new low for the year. On the plus side, what would I be excited about? Well, we're getting a potential bullish momentum divergence. Lower lows May and June, higher lows May and June in the RSI. So you're seeing a downtrend in Caesars, but with an uptrend in the momentum indicator in RSI, which could be an interesting bottoming pattern. You have to wait for confirmation, which is what I would be looking for on the chart of CZR. Finally, the GLD. One thing that has not played out is gold as a safe haven. And this is one of those market sort of myths that I love to try and dispel. There are plenty of times when gold works as a safe haven, but not all the time. And the problem is the strength in the US dollar has killed this. Note the RSI and the ranges in the RSI, bearish range to bullish range, and now very well in the bearish range. That is a brief and thoughtful nod to Andrew Cardwell, again, unfortunately passing away recently. Folks, that is a wrap for this show. Thank you so much for watching The Final Bar and supporting us and watching all of our great guest commentary. All of our previous episodes and interviews can be found at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.